You can move out of your own home, hand the keys to a tenant, collect their rent for years, and still sell that house without paying a cent of capital gains tax. That is a real rule. Most people have heard a version of it. They call it the 6-year rule, and almost everything they think they know about it is slightly wrong. 6 years is not always the limit. Sometimes there is no limit at all. And there is one line you can cross without ever touching the house that does not shrink this exemption. It deletes it. The whole thing, back to the day you bought the place. By the end of this, you will know exactly where that line sits. One line before we open the plans. This is general information, not personal advice. This is how the system works, not a set of instructions for you. Your situation is your own, so get advice before you act. Now, the rule has a proper name. It is the absence rule, and it sits inside the main residence exemption. By the end of this, you will understand why the tax office keeps protecting a house you no longer live in. You will see the clock, what starts it, and what resets it. You will see the version of this rule that has no clock at all and almost nobody uses. You will see when you actually have to choose, which is much later than people think. And you will see the line that erases the whole exemption for the exact people most likely to be relying on it. Start with the rule everyone already knows. Sell the home you actually live in, and the gain is yours. No capital gains tax at all. Not a discount. None. That is the main residence exemption, and it is the single most valuable concession an ordinary Australian will ever touch. The question this video answers is what happens the moment you stop living there, because that is where people assume the protection switches off, and it does not. Say your circumstances change, a job in another city, a relationship, you need more room, you move out, and rather than sell, you rent the old place to somebody else while you work out what happens next. The law's position is surprisingly relaxed about this. It does not ask whether you still sleep there. It asks a different question. Have you replaced this home with another one yet? If the answer is no, you are still, as far as the exemption is concerned, mid-move, and a house does not know a tenant is living in it. Structurally, nothing has changed. Here is the version most people have heard. If you rent that home out while you are away, the exemption holds for up to 6 years from the day you moved out. Sell inside that window and the entire gain across your whole ownership stays tax-free. Sell after it closes, and the house does not suddenly become fully taxable. You only lose the tail. Picture an illustrative example, round numbers, not a forecast. A gain of $600,000 built up over 12 years of owning the place. Sell inside the window and all of it is exempt. Sell instead after 8 years away, 2 years past the clock, and roughly a sixth of that gain on a simple time basis comes into the tax net. The other 5, 6 stay protected. Missing the clock does not undo the exemption. It just opens the door on the growth that happened after the door opened. Now the part almost nobody plans around. That clock is not a one-way countdown. If you move back in genuinely and live there again as your home, and then move out a second time, the clock resets. A fresh 6 years starts from the day you leave again. Somebody who works away and comes home between contracts or who returns between renovations can reset this exemption more than once across a lifetime, entirely lawfully, simply by living in their own house in between. Nothing is lodged, nothing is applied for. The reset is a consequence of the facts, not a form. And here is the version of this rule that most people have never been told. The 6 years only applies if the house is earning income while you are away. Rent it out and the clock runs. Leave it sitting there instead, empty, furnished, waiting, earning nothing, and the clock never starts. There is no limit at all. You could be gone for 10 years, 20, and if that house never produced $1 of income the whole time, it can still be sold completely free of capital gains tax on the day you finally let it go. So it is a genuine fork, not a trick. Rent it, and you take the cash flow with a clock quietly running underneath. Leave it empty, and you keep an unlimited exemption while paying to hold a house that earns you nothing. Neither road is the right one. Most people simply never realize they are standing at the junction. Before anyone gets carried away, the hard limit. This exemption only ever covers one property at a time. Move out of your first home, buy a second one, live in that instead, and you now own two houses that could each qualify. The law will not let you protect both. You have to pick. Keep the old home under the exemption while it sits rented or empty, and the new house you're actually living in, sleeping in, raising a family in, gets no main residence exemption of its own for that same stretch of years. Most people assume the house they physically live in is automatically the protected one. It is not automatic at all. And here is the part that surprises people most. You do not make that choice when you move out. There is no form on the day you hand over the keys. Nobody writes to the tax office. The choice is made years later in the tax return for the year you actually sell, when you finally work out which house you are treating as the protected one, which sounds convenient and is right up until it is not. Because the choice you make then has to fit the facts you created in the meantime, how the properties were actually used, actually treated, actually reported. So the decision is late, but the evidence for it is being written the whole time you are not thinking about it. Which brings us to the line from the start of the video. Everything so far has been about time and about choice. This one is about geography. If you are a foreign resident for tax purposes on the day you sign the contract to sell, the main residence exemption is generally not reduced. It is denied. Outright. Not the tail, not a slice. The whole gain, calculated back to the day you bought the house, lands in the tax net as though it had never been your home for a single day. And the trap is in the words. Foreign resident does not mean foreigner. It has nothing to do with your passport. An Australian citizen who takes a posting overseas, rents the family home out behind them, and settles into a life somewhere else can become a foreign resident for tax purposes without anything feeling like it changed. There is a narrow exception, and it is deliberately narrow. A short absence combined with a specific hardship, a terminal illness, a death in the immediate family, a marriage breakdown. Outside of that, being on the wrong side of that line on the day of sale is enough. So take the same house from earlier, the same $600,000 gain, illustrative round numbers, sell it while you are living in Australia, inside the rules we just drew, and it can be entirely exempt. Sell that identical house on the identical day while you are a tax resident of somewhere else and the exemption is not there to be claimed. Same bricks, same tenant, same gain. Now, this is not the tax office being sneaky about it. It is a deliberate policy choice legislated years ago, aimed at property held in Australia by people who live overseas. It is public, it is settled law, and it has been operating for years. But it is almost never mentioned in the same breath as the 6-year rule, which is exactly why the people at Catchers are usually the ones who are relying on the 6-year rule the hardest. So now you can read the whole plan. Move out of your home, and the exemption does not stop at the front door. Rent the place out, and you have up to 6 years of full protection, with a taxable tail if you run past it. Move back in and out again, and that clock starts over. Leave the house empty instead, and there is no clock at all. Across everything you own, only one property can wear this exemption at a time, and you do not choose which one until the year you sell, even though the evidence for that choice is being built the entire time. And underneath all of it sits the quiet line. If you are a tax resident of somewhere else on the day the contract is signed, none of the rest of it saves you. Same house, same tenant, same gain. What decides the tax bill is which version of this rule you were standing inside when you sold. If a rule, this generous being, this quiet, surprised you, there is a whole structure that works the same way. A wrapper that taxes everything inside it at one flat rate, sitting in plain sight that most Australians have never heard of. That is the next video. Subscribe if you want it the moment it lands. I will see you there.